Welcome back. We got carnage in the bond market. S&P is now dropping the uptrend, right? This is the uptrend from the October lows, okay? A lot of this is the end of the bull market trend. It's breaking it's breaking down, right? We're below 427. That was the level. Let's dive in. Let's look a little deeper, right? It's bleeding. It's bleeding beneath resistance. Is it over yet? Maybe. Maybe it's over, maybe not. So first, let's dive in to Mike Wilson, right? The big bear on the street. Let's dive into Mike Wilson's bear case. Let's talk about that bear case, Eric, right? So first off, he says 44% of stocks, and he just came out with this yesterday. 44% of stocks trading below their 200 moving average points to slower weakness, slower consumer spending, student loan repayments resuming, rising delinquencies, higher gas prices, weakening data, and the housing sector. Okay, weakening data in the housing sector. Again, like I said, they're downgrading Foot Locker, they're downgrading Urban Outfitters, Nike, all these retail spends, right? Consumer discretionary cyclical stocks they are starting to downgrade here. And he says to avoid basically avoid those cyclical stocks, right? Consumer cyclicals and housing, avoid that, right? And avoid the interest rate sensitive sectors. We're going to go through all this, small caps, etc. And it makes sense. It makes sense with what we're seeing here. And he says he recommends, right? Mike Wilson at Morgan Stanley recommends energy, industrials. So he's still sort of bullish here, right? He's not completely, he's not completely bearish to the nth degree. So this is Mike Wilson, right? Mike Wilson has been a bear in the street. We haven't heard him for a while because when you're moving higher and you're a bear, you don't talk. You could flip that around and say, when you're in a bear market, the bulls don't speak, right? I'm here every day though. We're talking about the bear case here, right? We are rolling over. Let's take before we get to the bond market, right? Let's take a look at this S&P. Look, the S&P is bleeding. Okay, it is starting to bleed. It is now below the long-term resistance, right? We got to face that fact. We're below the long-term support. I mean, you still have the week to go. You still have the rest of the week to go, but I mean, it's pressing that level of risk off, right? We get the macro forces also risk off, and this is something that you definitely want to keep in mind as we go forward here. Looking at the Qs, the Qs are breaking down. This was the wedge that the Qs were forming. That wedge is now breaking down. Now it's making a new local low. Real fear here in the market. When we look over at the fear and greed index, okay, looking at the fear and greed index, what do we have? Fear. A lot of fear, right? We're almost at extreme fear. We're at 29, below 25 would be extreme fear. So we're here, okay? But we're also extremely oversold. We're getting more oversold, and I think there's going to be a bounce there. And the question is this just seasonality, right? September, worst month of the year. And a lot of people argue this worst month of the year, right? And then you go into October and you typically get a rebound. So is that the case? I don't know. Well, let's look at the carnage because there is definitely a real case for the bears here. There's definitely a real case that this market goes much lower sooner. Okay, that it does have a risk off event. Okay, so we're gonna look into that. And it's all about the bond market. Just FYI, the bond market is really screaming risk off here. Okay, let's get to the slides. All right. So yeah, the bond market is what it is. I want you guys to see these. If you want to see the charts, go ahead and jump on to YouTube. Got the charts on here. Are you risk off or pulling through? I am risk off right now. I'm risk off. I'm risk off, but we're oversold. Bukowski, we're oversold. So I think we're gonna have a bounce first. So my thing is, I think we bounce. Let me try to explain this out first. I think we're gonna bounce first. And then after the bounce is where I'll say, okay, there's a bounce. Do we make is the high going to get back above support? If it doesn't, then I'm going to say, this might go even lower. But you're going to get a bounce just technically, right? Things are oversold. The shorts are covering. You're going to get a bounce. The question is, does the bounce hold or do you roll over back into a new low, right? So let's check out the bond because this is what's fueling it. We're going to go over exactly what's fueling it. First, rate risk, right? Rate risk is the number one headwind for stocks right now. 30-year yields breaking out. No, decline. 30-year yields surging. This is crushing the market right here. What's causing this and how does it reverse? What's causing it? How does it reverse? Well, first, let's get some background knowledge here. Let's get some background here. First off, everyone is dumping US debt. That is what's pushing up these yields. Everyone is dumping US debt. China, right here, was the biggest buyer of US debt. China's dumping US debt. They continue to do that, which are treasuries, which are bonds, US treasuries. Okay, the US Fed, next chart, is dumping US debt, 5 and 10-year debt declining, right? Mortgage-backed securities dumping debt. So they're dumping US debt, right? Traders, Bill Ackman, the bond vigilantes, they're dumping US debt in the form of shorting it, shorting the market. Okay? The US Treasury themselves are dumping US debt, right? They are dumping US debt, but not in the way, not like they're selling it, they're more so supplying it. So they're creating that. So falling debt in general, right? Falling debt equals higher rates. That's the concept here. Okay? When you have a surplus, right? You have a surplus of demand for US debt that creates scarcity. You have a surplus of US debt, right? There's more of it. People are buying it. Okay, there's more demand coming into the market that takes US Treasury or US debt, for, to make it easy, off the market. Bond prices go up, rates move lower. It's less risky. The rate movement represents less risk. Okay, you're going to get paid less yield, or puts are putting. You're going to get paid less yield, or the rates are going to fall because it's less risky. Okay, but today that's not the case. Right now, what we're seeing is a surplus of supply of US debt, whether it's China, US Treasury, the US Fed, or traders selling this debt. They're putting more supply. You have more abundance, bond prices fall, rate risks start to rise, or rates actually rise themselves. And because it's more risky to hold the debt, mortgage rates start to rise, which is threatening the US economy down the road. Unemployment, something could break here. Got to keep your eye on that. Debt interest payments start to rise. A lot of risk here in the market. So who's going to suffer the most from this? Okay, the mortgage market, obviously, right? Obviously, rates are at 8%. Mortgage market suffers. There's no buying. Sellers don't really want to sell either. It's frozen. Why? Because what are they going to do? Sell to go buy something more expensive, right? Actually, we did have some macro today. Did I miss the macro? No, it's in here somewhere. Because there's some bad macro happening with the housing market. Also, commercial real estate at risk. Small caps, they're not profitable, so higher rates pushes down their profitability. They don't even have cash flows to keep up. Long duration assets that borrow on the long end of the curve, 10-year and 30-year rates, right? Those duration assets that need long-term rates to be lower are going to suffer here. Consumer cyclicals are going to suffer because, not all of them, but they're going to suffer because consumers are going to spend less. Maybe not in this fourth quarter though. Maybe not. Why? Because we're headed into a spending season. But by Q1 of 2024, people are going to collapse their spending because they already bought the Christmas gifts. They bought, they did Thanksgiving, they stopped traveling. So Q1's probably going to be nasty. And this is what Mike Wilson is pretty much flagging. Okay, now if the dollar, okay, here's the risk off thing. The dollar is breaking out. The dollar is above the 106 risk off level, which is why, yes, I did short Tesla today. 245, I shorted Tesla. I'm still long Tesla. Okay, I don't tell people how I do it because it's confusing. It's not. I don't want you to just copy whatever. But I am short Tesla at the moment because I watched Tesla price action. I'm short at the moment. I'll unravel my short when I see things resolve, but the dollar's breaking out. The dollar is now breaking out. And typically, what do you get when the dollar breaks out of a long range? You get the S&P rollover. Okay, I'm not saying it's going to roll over all the way back to the lows, but it's definitely a headwind for the market in general. But we do have a positive here. Okay, here's something to think about, and I'm going to talk this through. Here's something to think about. Okay. Higher rates. Actually, do you guys want to see this there? Let me show you. I don't know why I took that off. I'm going to leave it up here so you can read it instead of just listening to my words. Okay. So here's the positive about this. Higher rates also present opportunities for companies. Now, this is going to hurt most of the market. The bond market is getting crushed, all-time lows. The bond market is getting absolutely crushed. Okay. US Treasury debt is getting crushed, but higher rates also present opportunity for companies, for the best of the best, who already have locked in low rates, right? They don't refi till 2027, till 2030, most of these big companies. So There's an opportunity here. Why? Because they have lots of cash. Their rates are locked in. You know, they don't have to refi till later, so these rates don't matter. They're not affecting them. They have a lot of cash on the sideline. What do they do with that cash? Okay, I didn't get there yet. But what do they do with that cash? They put it in the money market funds. They collect interest. They're not dependent on consumer spending because we know consumers are going to be slowing down. Consumers should be slowing down going into the fourth quarter and into Q1 and Q2. Those rate hikes start to come into the market, filter in, but and we're going to get to why there's more positivity here. They're not dependent on consumer spend, and they benefit from Q4 fiscal, okay? Q4 government spending. So the real switcheroo here is if you're dependent on consumer spending, you're going to suffer. Rates are too high, you're going to suffer. But if your business relies on B2B and fiscal spending is also supporting you, and investors are like, okay, I got to be in something, but it's not consumer cyclicals, boom, energy, industrials, they're going to benefit from spending. Also, some other specialties. I think Tesla is going to be one of those companies. Duh, obviously, I'm a Tesla bull. All right. So these companies can buy, and here's the big thing, these companies can do this. They can buy back stock. So they can make their stock more scarce, price goes higher, and they can, and this is only if they have enough cash, and they can fund their borrowing costs through the money market fund. So if they're getting paid 5% by parking $10 billion of cash in the money market funds, right? They're going to get paid 5%, and then they're only paying on their borrowed money 3%, 2.5%. Well, literally they get a cash flow. Now they're getting an income. They can literally use the Fed funds rate, the high rates for the market. They can use that to actually fund their borrowing costs. But not all companies can do this. Only a small percentage can do that, which is why I think the Magnificent Seven, maybe not all of them, but for the most part, they're going to get a bid here. They will get a bid here. We're already seeing Nvidia start to lift, some Tesla buying a little bit. I think Tesla's going to lift also. It's stronger than the overall market. Now, what do you got to watch for? What is the downside? Rates. Here's the upside. Here's how rates actually can ease. Okay, here's a way that rates actually ease. Rates will ease because remember, the bond vigilantes are shorting the market. Okay, they're shorting the market. China's dumping, the US is dumping, the Fed is dumping, but we still have the reverse repo facility. They're buying up short term. So it's really long term that's at risk here. So how do they capitulate? If something breaks, they capitulate just like in March when SVB broke. They capitulate then. So watch KRE. Maybe I'm wrong about KRE, but that is the regional banking sector. Something might break again. Okay, and then you get the Fed come in and sweep things up, and that'd be positive because it'll increase net liquidity, and it'll also reassure the market, hey, we'll step in and get your back. If you have comments, throw them on the YouTube link in the channel so they don't get lost here. I'll try to come back to them, but it's easier if you go to the YouTube. I can see your comments. They'll stick in there, right? US makes a deal with OPEC. Okay, we know we've had US officials speaking with different countries, you know, trade relations, and we need to get these energy prices lower. But they're not going lower unless we present a better deal. Now, do we have the, people in the White House to do that? Who knows? But we do know they're looking for a better deal. They're forcing their hand. They're choking the U.S., right? You see Russia banning diesel fuel. They're choking this is a big political move. This is a geopolitical threat here. They're choking the U.S. OPEC choking the U.S. to some degree. They want a deal. They want something that benefits them to get the pressure off. So that deal could roll through, and then boom, all the risks for that reflation come down. Oil starts to ease, right? Those risks come off the table. Am I betting on it? No, just keep your eyes out for that because that'll relieve some pressure here, okay? Now, the long-term picture also, the Fed isn't really selling long-term debt. So we know the long-term treasury is up. I don't think this is China dumping. I don't think this is the U.S. Treasury. Well, it's not the U.S. Treasury. They're not really dumping long-term. That's literally what this is. The Fed is not. I mean, we can go to the chart. The Fed is not actually, they're not actually rolling off. They're not selling long-term treasuries. They're selling short-term treasuries from anywhere from 1 month all the way to 10 year. So the 10 year is going to have some fluctuations. But the 30 year, I believe, is purely the bond vigilantes, purely people shorting TLT. They're shorting TLT, right? That is the benchmark ETF for citizens, for retail to get in, and they're shorting it. While retail is told, go buy bonds, and they get shorted, right? So the positive here is that in the long picture, guess what? The Fed isn't really selling long-term treasuries, not a big pressure. The other big picture, the US Treasury isn't issuing long-term debt. So it's all these bond vigilantes, something breaks, they capitulate, right? Shadow QE remains. We still have shadow QE. Is it really buying up long term? Probably not. It's probably more, it's going to be buying more short term, but we still got shadow QE, right? From the Fed, from the reverse repo facility. Bond vigilantes will cover at the whiff of a break. Maybe GDP slows. We get GDP at the end of the week. Okay, Thursday, Friday, we get GDP, we get Powell speaking. Will he cause them to capitulate? I don't know. Because his fear, because if he does fearmonger, if he does pitch some fear, he'll also scare the market. So I don't know. We might really need something to break or some orchestration where, you know, maybe something is breaking and Powell's like, hey, we're going to announce this break, but we got your back. Bank term funding program, right? More oil supply versus demand. Down the road, we know demand is slowing. This oil move is based off supply. It's not exuberant demand. It's not a real threat. It's not a systemic threat. It is literally the central bank of oil. Okay, it is literally them cutting the supply, right? Cutting production, making prices go up. That's much different than crazy demand because you can't just stop crazy. Well, you could stop crazy demand, but that's more systemic because the economy is moving. What is the name of Shadow QE? Shadow QE, Tigger Media, is the reverse repo facility. I'll show you that right now before we move on. So short term, we'll get to Shadow QE. Short term, macro forces are signaling risk off. So let's go to reverse repo facility, okay? And then we'll go to Shadow QE because this is keeping the market liquid. I think the buyers step in here. There's a lot of fund managers offside. Here's Shadow QE. What this is the reverse repo facility, okay, which got up to 2 trillion. I have it inverted because it's inverted because it kind of shows you how liquidity is coming into the market, right? But if you put it back to where it goes, let's say this is the top, it collected $2.5 trillion of Fed funds. I'm sorry, not Fed funds, of liquidity. Okay, this is where people park their money at the Fed, risk off, and they collect the rate on it. So it's, you park your cash here essentially, and you get paid the Fed funds rate, right? So the Fed funds rate fuels liquidity to some degree if you have a lot of cash. If you're borrowing a lot, it hurts you because your interest payments get bigger because they increase the rate. But if you have cash and no debt, which is where all this money is going, it's a bunch of cash, you're getting paid the Fed funds rate, okay? But this has been leaving. This cash has been leaving. Why? Because US Treasuries at the short end, let's go to the short end really quick, 5.5%, right? You're getting paid 5.5% here at the short end. These are short end rates, right? 3-month short end rates. And you refi it every 3 months. Well, you're collecting 5.5% every 3 months. That's way more money than collecting 5% or whatever the Fed funds rate is, right? A little probably under that. They're going to get undercut for the whole year. So this is why it's leaving, because there's better risk here. There's more incentive to be in short-term US Treasury debt. There's more incentive there because you're getting paid higher. Plus, it refis every 3 months, right? It's 3 months. So all of a sudden you roll it over next 3 months, right? So that's what QE, that is what Shadow QE, it's been coming into the market. Check this out. Tigger, check this out, right? We look at the S&P. Now it's kind of diverting today, obviously. But when we dive over to the S&P, what does it look like? It looks like it's kind of not one for one exactly, but we've had reverse repo liquidity support, right? The money market fund support. Now it's diverting simply because 10-year yields and 30-year yields are moving up. What does that do? The more that these yields move up, the less collateral is in the system, because literally the opposite is bonds are falling. As US debt decelerates, keep this in your head. As US debt, because you want to know why, as US debt decelerates or falls, right? The value of it falls, there's less collateral, therefore less lending. So people leverage the US debt to lend out 5x, 10x the actual debt. It's collateral. But if your collateral falls, then it pulls liquidity out of the market. And so either way, it's hurting the market, right? It's a net negative. So that's what that is. That's what we're staring at in the face here. And I think the real question is, right? Did we get through the whole slide? Yeah, I think the real question is, all the macro forces are signaling risk off though. So this is where I'm a little worried. Yes, we have the RRP, we have the shadow QE in, but the macro forces are giving me a risk off, which is why I shorted Tesla today. And how long, that doesn't mean go short Tesla at all. It doesn't mean that. It just means for my situation, for the way I am set up in my strategy, I got to short when the signal tells me. So I'm shorting some Tesla. I just don't think it lasts. We're going to bounce at some point. So here's the macro forces. The 3 most important macro forces, okay, are number one, well, let's not go to the dollar yet. Number one, it's going to be these rates. It's going to be these rates. We know they're surging. They're making new highs. The short end is not as bad. So look, the short end isn't breaking out because the reverse repo liquidity is eating these up. Okay, so it's not that bad. You go to the 5-year, it's kind of worse. You go to the 10. The longer you go out, the worse the rates because there's less support because the reverse repo facility, the Fed shadow liquidity, shadow QE is not eating up these treasuries. It's not eating up this US debt. So the 30 years is launching up, right? So that's a negative. Okay, the dollar. Well, rates push up the dollar. This is the real worry. This is why I'm like, crypto might struggle here. Hopefully not, but crypto's probably going to get a hit here because the dollar is the wrecking ball. Now it hasn't exploded higher, so we haven't really got the big risk off from the dollar. It's mostly rates. But if we do see the dollar make a big meaningful move to the upside, that is a risk off signal. Okay, that is going to be the dollar wrecking ball because everything is priced in dollars. So literally it's value at risk. It's a value at risk shock, meaning your value goes down because the dollar went up. But we haven't got that big shock yet. The problem is we're above 106, where there's probably a lot of capitulation here. They're probably going to get some dollar shorts, right? Some dollar shorts capitulate because the level is being violated. They have to buy back dollars. Boom, goes higher. Blase, whatever. But it is oversold. It is, I'm sorry, overbought on the RSI. So the dollar is overbought. So I do expect this to reverse, but I think it does need a catalyst. I don't think it just reverses technically because it's a macro force. It's not a stock, right? Number three, this really sucks. Oil prices going higher, right? They've been consolidating lately, but this is the other big macro force. Probably the only reason they haven't shot up is because the dollar's up. Oil is priced in dollars. If dollar goes up, the denominator goes up, the numerator, oil, goes down, right? But in this case, it's not going down, so it's very strong. There's a lot of strong bulls in there, but also overbought. So all these macro forces are signaling, okay, they are signaling risk off, but there could be a reversal, like I said, if we do get the UAW strikes resolved. If we do get at the end of the week, what do we have? At the end of the week, we have the debt ceiling crisis, more geopolitical crap. If we get a deal with OPEC, right? So it's all these ifs. But for now, right, the VIX is surging. The VIX is now getting to that 20 level. That's dangerous, right? Above 20, you have real risk in the market. Above 20. So we'll see if this lasts going into the end of the week. Move index, also bad news. Bond volatility is picking up, which means your collateral is at risk. It is signaling collateral. The good side, the positive here is equity credit risk still isn't rolling over, which is why I think the Qs get bought up here. Because like I said earlier, if these big mega cap companies can, just take their cash, put it in the reverse repo, well, they're getting paid 5%, right? So that takes care of their borrowing rates. Therefore, the rates that are surging mean nothing. The rates that go up mean nothing to them because they can collect interest on their cash. But you have crappy, you are going to have some bad market breath because not all companies can do that. Most of them can't. They don't have cash, which is why IWM is bleeding. Okay, small caps here. What am I doing? Got to put here. Let's go here. This is why small caps are bleeding because they can't use the reverse repo facility. They have no cash. So they're bleeding out. Okay. Equal weight bleeding out. Equal weight bleeding out. Dow bleeding out, right? They're all breaking the trend pretty hard. NASDAQ is also breaking the trend, but like I said, once you get oversold here, you're probably going to get a bounce. No, you will get a bounce. We're going to get a bounce. If you look at futures, we're at the trend. So S&P futures are at the trend. We'll get a bounce. Like I said, the question is, can we get back above the previous big level? So if you're looking at futures, that big level needs to be above what, 43.84. Well, that's too many numbers. Just look at the level there. You need to get back above this level. I'd even call it 4,400 on the futures. You want to get above 4,400 on the futures. If you're looking at SPY, you want to see SPY get above that green day, which is about 432, right? 432, man, that was a nasty drawdown this morning. We had a bounce, and then you just gap down. You try to move up, you fill the gap almost, and then you just sell off, right? Typical trading, typical trade. This is a lot of momentum on the downside. I don't necessarily think something is broken yet, or there's really strong negative catalyst playing out. But the trend is telling us, hey, if something does play out, if these strikes do get worse, we're in trouble. Now that brings us to the macro. Where did I put the macro at, right? Right. Where did I put the macro at? Because we got some bad news for, not bad news, we have some negative macro. Oh, there it is. Oh, you know what? I skipped it. That's what I did. Okay. So here, we'll get to it right now. In the macro, the negative for the macro is the Baltic Dry Index has gone up 30% since end of August. The Baltic Dry Index, that is supply chains, right? Supply chain pressures. Is that what that is, Bukowski? The Baltic Dry Index. Mm, is this an equity, or are you talking about an economic activity measurement? I'm not sure. Again, if you're on TikTok, re-ask your question or your comment because it's lost in the feed. Can't see it. Just throw your comment in there if you had one or your question. So what I was gonna look up. Oh yeah, let's get to it. All right. So, man, what did the Fed say? The Fed said that we definitely want housing prices to slow in black. These are housing prices, okay, from the FHAA. These are, yeah, FHFA. Oh, my bad. FHFA housing price index. Those prices are still going up. Basically, average house prices eased below 400K and then they went up again. So those are still rising, but this is July's data. So it is backwards looking, but it shows, backwards, hey, prices are still coming up. So does that make them hike again? Possibly. At the same time, new home sales, right? New sale volumes are falling. Duh. I mean, right? Mortgages are down. That's not good. Home builder sentiment. They're not building as much, even though there is a lot of building permits. They're not building, but they're gaining the permits. I think they're going to be building apartments, which are non-mortgage housing, right? Non-mortgage rate housing is catching a bid or is receiving some economic activity, where so the mortgages are not, the mortgage homes are not. So yeah, that's what we said. Building permits up, housing starts are down. Housing starts lead the market. I'm sorry, building permits lead the market. The question is, where's the market headed? So that's basically in trouble. That was the data we got today. We also had what else did we have? We also had some oh, that's for Wednesday. Where's the other data at? The Dallas Fed, the Richmond Fed manufacturing index. It was positive. Okay, for the first time in what? The whole year? So I still think economic activity is picking up on the industrial side, which is probably why Mike Wilson said industrials energy, but consumers are going to slow, right? Consumers should slow, and maybe they don't even slow anytime soon because you still have the biggest spending of the year we're heading into, right? Yes, shipping rates of dry bulk like coal. Okay, that's not good. So these are shipping rates. Shipping rates, and then if you look at the what is it? The global supply chain index. I usually look at that. The global supply chain pressures index. It is bouncing, but it's still very low. I think it's still negative. I'm not sure. So the dry Baltic, that's yeah, it's putting pressure. It's putting a lot of pressure, which the macro, like I said, risk off. It does not look good right now. You need the dollar to roll over. You need rates to roll over. You need oil to roll over. But I still think if the dollar rolls over, rates roll over, oil is not at a crazy level. The dollar is, and rates are. Oil, oil could be a net positive. You're gonna get energy. You're gonna get rotation into energy to some degree. So that's not too negative, right? Richmond Fed. So another. No, we went over that. Not Richmond. Dallas. My bad. Dallas Fed manufacturing. The services index. This is what you don't want to go negative. So it recovered, went negative. So Dallas manufacturing still negative for the services side, right? Yeah. Well, I guess these are kind of mixed up. Either way, economic activity is pretty. And then we'll get building permits again. We'll get some more building permits volumes. I guess later on. This doesn't show me the time, but back to the charts. Right, back to the charts here. S&P is definitely starting to roll over. Let's get a clean chart here. We've broken that line. Now look, I don't think it's over yet. I don't think it's over yet, but we are basically at the point where we're not in a bull market anymore on a technical basis. We're not in a bull market on a technical basis if we hold 80% of people have less savings than yeah, exactly. Savings rate dropping, bro. Big drop coming. Looks like we could have a big drop. I think we go higher first, and then we will price in the big drop. I think we go higher first. Obviously, I could be wrong, but technically, a lot of investors are offsides. They're not overweight. I think when things get bad is when you're overweight. But a lot of investors missed out on this move, right? They missed out on this move to the upside. So they're like, we need a big pullback, right? We need a big pullback. We want to see a pullback, and then we'll get in. They want to see some fear. And what does Warren Buffett say? Buy when people are fearful. So not at the beginning of fear. This was the first fear. This is the second fear leg. Now we're breaking down. So I think buyers step in here. Okay. S&P, NASDAQ. I think they're going to go for stocks. So stock picking those stocks who do not depend on consumer spending, those stocks who do not depend on the things that are weakening interest rate, the interest rates, IWM, they're going to dump those. We see that. But what about fiscal policy coming in the fourth quarter? They're going to get incentives. Tesla literally gets a $7,000 rebate, $7,500 rebate on all the cars, right? So you're getting fiscal spending, which, it makes inflation go higher. Not necessarily, unless you give checks to people. Okay. But it is inflationary to some degree for asset prices. Okay. Inflation Reduction Act, maybe Caterpillar. What is Caterpillar looking like? Right? Caterpillar still at the highs. Like, see, these things are not rolling over. I think there's a bid here. I think there's still a bid here. Caterpillar has a nice little, falling flag. The overall market's rolling over. So of course, Caterpillar, but this is an industrial stock, right? This is industrial. If we look at, I think Apple looks kind of weak. Yeah, Apple retesting those lows also. Who's it? Meta, Apple, Amazon, Google. So I think there's going to be some dip buyers in some of these markets. They're still trending up. It hasn't broken. So, and these are bigger. Google's bigger than a lot of probably 100 stocks in the IWM. So you still have, I guess you could say that trend did break. So we'll see. I think the buyers step in here though. I think they're going to step in, and if the water's okay, it keeps going up. But if not, then we roll over. If those rates continue to climb, we're in trouble. If the dollar continues to break out, we're in trouble. If oil keeps going up, we're in trouble. Risk off. Period. Right? Period. But the catalyst risks are still something that could change. Let me see. Head and shoulders on S&P. Yeah, that already broke through. We broke through that head and shoulders. I'm pretty sure the head and shoulders kind of played out on the S&P. Let's take a look. Yeah, the head and shoulders played out. There's your shoulder, there's your head, there's your shoulder. So it did play out, or you could say it's still playing out. You could say it's still playing out. Maybe we come down to 420, which was that initial breakout area. Okay, we could come down to there. But for the most part, yeah, it's day to day at this point. But the bull market is the bull market. I don't want to say it's ended yet because we need more confirmation. Powell speaks on Thursday, and we get PCE on Friday, which excludes oil. If we get a really good personal consumption, the Fed's preferred inflation gauge, if we get a really good number, the market could like it. Because the only way this market bounces with all these risks is that inflation improves. Not the headline. We know that's not going to improve because oil's up, but the core. We need core to improve. And if consumers are slowing, right? If housing is weakening, if shelter prices are falling, the core stands to show a pretty good print here. Okay? Even if it's not this month, it'll be the next month. So I don't think it's over yet. I want to see the PCE come in, the market digest that, and if we keep struggling below 431, 432, can't get above it, probably roll over. It's going to be nasty. The move Meta is acting by itself. What do you think about Meta? See Meta. Yeah, I think the Magnificent 7. Oh, that's what I was going to look at. Nvidia. I think the Mag 7, again, investors are going to seek. They're gonna seek safety in these stocks. Oh, they're not safe, dude. They have too big of cash flows, and what can they do with high rates? Okay, let's invest that cash. I'm telling you the game plan. They can just invest their cash at the money market funds, collect the interest, fund their own growth. As simple as that, right? You just got to have a lot of cash. Let's see. Bull, and I'll get to you, Bukowski. What what are the Bull King saying about Dr. Tom Lee? Um, Dr. Tom Lee, we'll see what Tom Lee says. I think what they're saying, I'll show you some of their, I'll show you what these guys are saying. Tom Lee, we'll go dissect what Tom Lee. That's a really good question. Yeah, let's go to Tom Lee. They're showing a lot of technical analysis and sentiment indicators. So yeah, they think we get a bounce and then 4,400. So like if you look at S&P, what they're saying is basically 4,400 is going to be the level that we do bounce, but 4,400 is the dangerous level, the level, not dangerous, but the level that they are not sure in these conditions the S&P can get above. So we're looking at right here. That's what Tom Lee's saying, and I'll show you exactly what they're going through. Let me just finish these. Bull market, Fab 7 market. Yeah, probably the Fab 7 bull market. SMCI, SMCI semiconductor. SMCI, see, SMCI is not even falling. I think it's a stock pickers market. We haven't seen this for a while because low rates, everything went up, but now it's like who has efficiencies? Who can actually use this environment to their advantage? You got to have a lot of cash. You got to be able to park your cash. You got to have a revenue. You can't be too dependent on consumers. Are semiconductors, are they dependent on consumers? You don't go buy semiconductors. No, their revenue comes from business investment, which is going to be supported by fiscal policy with the Inflation Reduction Act, with the CHIPS Act, right? That's why I think this is going to be a stock pickers market. S&P may go sideways. NASDAQ may be higher because it's not so much dependent on consumers, but for the most part, certain individual stocks will probably keep going up unless you get a big risk off event, like I said. So that's SMCI. So let's go to you need reading glasses. Would you say I need reading glasses or upgrade them? Yeah, I'm blind. I'm pretty blind. All right, let's go. Oh yeah, here we go. Tom Lee. So let's look at Tom Lee. Okay, so what he's signaling here, S&P 500 down 5% from peak of August. Here are the storm clouds. We just talked about government shutdown. Can that be resolved at the end of the week? Maybe, maybe not. UAW strikes. Does that turn into supply side inflation, right? $90 oil, student loan repayment, slowing down the economy, interest rates higher, sentiment awful. Yep. So here's what here we say. Morgan Stanley, we remain more optimistic than the Fed on deflationary process. Our team sees real rates remaining relatively flat in 2024. As such, markets are ripe for 50 to 75 correction in the Fed's path. Okay. So they're seeing Fed funds actually come down. Interesting. Okay. Or maybe they're talking about bond yields coming down, probably as growth starts to slow down. So here's what I was pointing out. What they're saying, or what Tom Lee is saying, or Mark Newton, the technical strategist, that the S&P could rally 75 to 100 points this week. Okay, at the end of the quarter, stalling out because what, September is the end of the quarter. Yeah, so he thinks by Friday we rally, but not above 4,400. Okay, not above 4,400. We're pretty technically oversold, and buyers should step into some stocks, right? So we'll see how that plays out. Oh, I'm always reading things wrong. Yeah. No, I do read things wrong. Good looking on that. I speed read through it, and I'm not the best reader, to be honest with you. I'm a slow thinker, man. Come on, give me a break. Um, what was I reading wrong though? Was it did I miss something? Because I want to make sure the concept is solid. I want to make sure we get a solid concept, right? If I mess up the concept, that's one thing. But yeah, so that's what Tom Lee is saying. Definitely, that's what Tom Lee is saying. I probably read your stuff wrong, huh? Oh, the Tom Lee, was it the Tom Lee thing? What are the bull king? You know what? Some things, what are the bull king saying about this Mr. Tom Lee? Bro, honestly, that sentence, I guess it's just kind of weird. Just kind of a weird sentence, not that clear. if that's what you're pointing out there. Um, so okay, yeah, so that's Tom Lee. That's what they're saying. Basically, on a technical basis, we're oversold, and there's a lot of room for a bounce here. Okay, and the question is, can we get above that bounce? Also, again, back to seasonality. You see SMCI, you see this semiconductor. What is it doing? Semiconductor is wedging pretty hard. It looks pretty solid there. And then Nvidia. You still got some buyers in Nvidia. It's not rolling over yet, which tells me there's still optimism in this market for very specific stocks. I think it's just a stock. I mean, even Morgan Stanley's Mike Wilson, what was he saying? He was saying energy industrials, right? Energy and industrials. So what's a good energy stock? Also, I heard that oil is outpacing a lot of these uh, energy stocks, maybe Chevron, whoever it is, because they've already been up on the year, right? They've been up a lot on the year, and there could be over positioning in these energy names. Positioning is very important, right? Just because you get positivity doesn't mean the stock prices move that fast because you're over positioned. When people are under positioned and they're surprised, that's when you get a big upside move. So, energy stocks will still benefit, but are they still is energy the best play? Probably the best, safest play, right? But what happens in the fourth quarter when supply overcomes demand? When the US makes a deal, all of a sudden these things roll over, right? Well, where big tech has a secular story to it. AI is real. ChatGPT now has voice and can talk and can do something. I don't remember what it was. ChatGPT can now do other things. Like, I don't even know. I'm not keeping up with the AI revolution, but I know it's like an atomic bomb, right? So you got to keep track on that. You got full self-driving from Tesla. Amazon's coming out with a bunch of AI stuff, new products, buying up other companies. So Apple, I mean, I don't know what Apple's doing, but I don't even have to look. I know they're going to innovate. They have a lot of cash. They're going to be fine in this market, right? Consumers are not. So if you do get a big, if you do get a scare, you get a scare. Something, if there's some type of event, then you get an event here. But again, I expect liquidity. I expect the Fed to come in if something does happen. Fed's balance sheet. Now, if we check net liquidity here, let's see, Fed net liquidity indicator, still pretty flat. Okay, and all this is this is basically RRP plus the Fed's balance sheet plus minus the TGA, blah blah blah, a bunch of stuff. And if this thing breaks out, I mean, oh, no wonder. I was gonna say let's go to the 1 day here. Yeah, so Fed net liquidity, right? If something breaks, I mean, the market's probably gonna bar first. Okay, if something breaks, the market barfs. And then as soon as that Fed net liquidity comes back in, market goes higher. Because it's suffering from liquidity. Check this out. Global liquidity is making new lows. Right? You got global liquidity also making new lows here in the blue. And you'd expect this to really hurt crypto, but it's not, because I think there's some investment coming in as a divergent asset. Um, I mean, you got stuff like Chainlink, right? I know this is out of most people's purview, but it's still been grinding up because of the secular adoption of it. So what do you do? Do you get net short? What are some shorts? What are some shorts? What are some? Do you guys have any? Do you guys have any charts that are very nasty that you could short? That you could, if we do go into a bear market, look at Target. Oh my gosh, let's just go back to the names that were getting crushed. Target. Oh, the bears are loving it. This is probably the best opportunity, honestly, is to short individual names, because these things drop like a rock. They drop like a rock if you're a trader. Okay, if you're not a trade, like S&P is probably going to bounce here, but a lot of these names will roll over. They're not going to be able to keep up. So you got Target rolling over. What else do we have rolling over? What are some bears? What are some bear cases here? How do you see global liquidity? You go to, I mean, jump over to the YouTube and look at the YouTube. It's basically you go to an indicator, Just go to your indicator and then type in global net liquidity. Global net liquidity for an indicator on TradingView. All right, so we got Target rolling over pretty hard. I mean, shorting could be fun, but that's a whole different way of looking at the market. You're looking for that short-term pain. So Target maybe comes down to 90. Enjoy that one. Okay, who else was getting smashed earlier this year? FL rolling over again, maybe. Especially Foot Locker got downgraded, so they probably get smashed. What up, Asan? Healthcare sector gets a bid on risk-off events. XLV. Probably, I don't think it's going to be material though, right? Even if healthcare gets a bid, I don't think healthcare has enough juice to really like to be sustainable. But usually it does. It hasn't really performed lately, and that could be for healthcare prices coming down eventually in the cycle. So I'm not sure. You do have biotechs biotechs are moving up pretty quickly. See, what is a biotech? Oh, there we go. IBB. See, biotech's got a bid today, but it's a bunch of penny stock traders based off of what is it? Round one, not round one, but basically phase one, positive phase one tests or something, whatever you call it. I don't know the lingo. So biotechs will go up a little bit if this continues, and then they'll sell off. They're just trade. So healthcare, no. Let's see. Consumer discretionary getting smashed. Nobody's going into staples or defensive. So these are defensive. Oh no, this not defensive. These are defensives, right? Consumer staples. Nobody's going into those. So healthcare maybe again. I mean, your best bet is probably energy on a pullback. My guess is energy on a pullback, and that oil price keeps going up. That may be your best bet if you're looking for the bull side. If you can short, your best opportunity is probably going short some of these really trash names. Who was it that Mike Wilson was shorting here or downgrading? Let's take a look at those charts. And yeah, QQQ. We looked at QQQ a little earlier. Asan, I'll throw that back on there. It's basically breaking that bull wedge pattern. The Qs are breaking the bull wedge pattern. They are pulling back, but they're pretty oversold, right? They're gonna bounce here. They'll bounce here. And then once we get the bounce, can we get back above 360? I think you need the Qs to get above 360 and hold. If not, maybe they keep rolling over, and you really just you can really look at it like this, right? Where it's more so turns into a break of trend / bull flag. Still a bull flag though, right? You're coming off the lows. You're still trending up. And you just need the bull flag to break out. So if it breaks the structure, it's going to be nasty. So Mike Wilson, let's go to Mike Wilson. All right, so Mike Wilson, or Morgan Stanley in general, they downgraded Foot Locker, Urban Outfitters, Nike. What does Nike look like? Dang, what is Nike's ticker symbol? Man, I can't even remember. What is Nike's ticker symbol? Shame on me. I should know that. I know Foot Lockers. What is Nike's ticker symbol? Oh, thoughts on Zoom. Yeah, we'll look at Zoom right now too. Oh yeah, NKE. Brain fart. Let's see. So Nike got downgraded. Maybe you wait for that pull in. If the overall market keeps rolling over, you wait for Nike to pull in here, right? And retest somewhere around 96-ish, 96, 96, 97. That's probably where you would short Nike. You want to see it pull in, can't get above, boom, starts to roll over again. Zoom. Zoom, I'm a little frustrated with Zoom. I'm not gonna lie. I mean, it's still trending up, but I'm like, bro, come on, break out already. It's been a while, but May need another earnings report. Josh Brown was buying it, said it would be a nice trade. Their fundamentals are pretty good. They have enough cash. It just might be a late cycle mover. It might take a while to see Zoom definitely go back up, but Zoom needs to hold above 75. It just couldn't do it those past couple times. I'm still holding my Zoom calls. We haven't broken the trend yet. I'm down on them, of course, but mine are 2025, so I have a lot of time. Now, if the whole market just tanks, if something materially changes, then I'll get out of my Zoom calls because I don't want to hold that duration and just let it the theta eat me up. I definitely don't want to do that. So I'm keeping my eye on some of these things. Okay, other trash stocks. See, help me out here. What else is getting wrecked? I'm gonna take a look over here. MCD. Ooh, dang, McDonald's got smashed. Okay. I mean, McDonald's is pulling into a pretty strong support here. So I don't think I'd be that interested unless it made a move like this back up to 275. Right? You make a move back up to 275 possibly. Um, is McDonald's your best A plus setup? Are people gonna stop spending at McDonald's? Are they in trouble? Maybe they are. Commercial real estate? I don't know. I'd have to dive deeper into it. 3D Systems Corporation, Triple D. You're talking about getting killed. Ooh. So Triple D Systems, 3D printing. Wow. That is breaking to new lows. Man, these rates are really crushing long duration assets. And I think too, because a lot of these companies have no earnings. So they're all based on borrowing capital to fund growth. But if the capital keeps going higher, it's a double effect. Not only is are you able to borrow less, your interest rate is higher and you just pull out. There's no more funding coming in. So these are probably getting smashed here. Palantir, 3D Systems. I can only afford McDonald's. Oh, you can only afford oh, you can only afford to buy McDonald's. Come on, man, don't be buying McDonald's. Uh there's probably other stuff you can buy. McDonald's is gonna crush your health. Go find some deals at the grocery store. What state do you live in? Maybe your city should have you might be able to find some deals at the grocery store, some chicken. I don't know, because I haven't compared McDonald's. Maybe there's some ground beef. That's not too bad. I don't know. Palantir. Palantir is an AI name. I don't think even though it has that head and shoulders, I mean, this should break lower if it does. Like if it does break lower, it's going to be nasty. There's probably a lot of traders looking at Palantir here. I don't think it's easily of a break because of what they're doing with AI and they keep getting new contracts, a lot of good catalysts. But if it does happen to break below 1360, right? 1350 and then gets rejected by 1350. You could say 1350 is probably the number, right? 1350, maybe it comes back down to 1150. Ooh, that'd be pretty nasty. Probably does this. Palantir does break down. It's probably going to look something like this. Probably breaks down here, tries to come up, and then because then you have the descending wedge. Got the descending wedge there. American Waterworks Corporation. Give me the ticker. You said for American Waterworks. What's a ticker for that? I have no clue what that is. And the market is pricing in a cut. This will be bad if the Fed over these next couple of days are going to be crucial. If the Fed does signal we're going to increase rates, which I don't think they're going to do it this week. It'll be next. It'll be the next because we got a whole month off, right? November we're off. I'm sorry, October we're off. So it'll be somewhere in the mid October where the Fed signals we're gonna hike again. Twilio, yeah, TWLO Twilio. Twilio still in la la land, just like Zoom. These guys are still in la la land. They need rates to lower because 30-year rates are gonna pressure these assets because equities are asset class, but these are long duration assets. They're looking at long-term rates for funding. So they're just going to struggle. They're not positive earnings. They're not building any earnings yet. So you got to take a risk on them. They're still going to work in the future as a long-term buy for sure. But until you get above this level for a trader, like as an investment, possibly Twilio probably does really good. AWK. So you said as a buy, American Waterworks as a buy. I don't know the fundamentals. I really don't. Maybe it is. I don't know the fundamentals of it. My guess is American Waterworks. I have no clue, to be honest with you. I'm not even gonna try to guess. I have no clue. I have no clue if this is a good or negative catalyst. No clue at all. I know consumer staples are probably gonna get crushed. Let's look at a couple consumer staple plays here. Oh, okay, there we go. See, Mike V, if I miss your comment, jump onto the YouTube and ask the question. Then you could jump back on TikTok. It gets lost in the feed. Need your input on CGC. Oh man, you're in those cannabis stocks, huh? I remember CGC back in the day. Uh, CGC. Yep, I remember trading this back in 2018. CGC to the highs. Yeah, Jim Cramer was like, "This is the stock, CGC." CGC looks like trash. Probably peaked out here. I think there's probably the reason this thing went up, and I haven't like immediately looked into it, but I think a lot of it, this is a lot of trading. There's not really real buyers here. There's probably not a whole lot of Wall Street real buyers here. So I'll break it down this way. This was a short squeeze. This was purely, okay, a strong hold and a breakout and a short squeeze off of a catalyst, some type of government regulation. But in this market, these companies have no earnings. So they're really risky plays. If you're looking long term, I wouldn't even look in cannabis. If you have an edge somehow, great. I do not. And there's too much supply. I don't think cannabis has a real I just don't think cannabis companies have a real edge at all in this market. And hey, maybe I can be proven wrong. That's just my ideal. That's just the way I think about it. But as a trade, it could break out and move higher, but you're going to need rates to come down, not in this environment. These are risks. This is a long duration risk asset. So it needs long rates to come down. LLAP. LLAP, what is this? LLAP Orbital Tehran Orbital Corporation? Bro, what is this? LLAP? Aerospace Defense? Ooh. 150. This is a penny stock. Yeah, this is a penny stock. Fundamentally, I mean, the company could fail. This company could definitely fail. I would go into the aerospace if I were you. If you're already in it, I mean, it's getting destroyed. Wait for a pop, get out. Again, I haven't done deep research on it, but I'd go into aerospace and really do some research on who has the biggest edge. Because if you're holding this, I mean, you're competing against Lockheed Martin, RTX Corporation, Boeing, General Dynamics. I mean, I'm not familiar with this industry that much, but these have a high fail rate, very high fail rate. I would not be trying to catch bottoms until if interest rates got cut and the Fed started buying back US debt, then these come into play. They could probably just move up. But in this environment where you're in QT, hell no. They're going to get smashed. Yes, they're going to get smashed pretty bad. Everything's getting wrecked 100%. Okay. Um the things getting crazy sell off, right? This is going to be wrecked for a while to go. What up Josh Dobson. Shout out to Josh Dobson. Go check out the real estate plan. Palantir, is that what you meant? Mobian. What are your thoughts, Josh? Yeah, the mortgage market looks, I mean, those 30-year rates are just surging. They're just surging. So I think we said earlier, something either needs to break, or the US needs to get a deal with Russia and OPEC. Russia or OPEC. Um for the 30-year. Short-term rates are okay for now. Or something breaks. That's probably it for the mortgage market. Rates move higher, stocks fall, Fed pivots. Yep, that could be it too. Stocks are also the collateral to the system. This is just the beginning. I'm not as bearish as you, Josh. I'm definitely not as bearish. On the economy, I'm probably not as bearish as you on the economy either. But again, you have different insight than I do. I think if the economy does slow a lot, it's going to be Q1 of 2024, because like we talked about, the spending slows. You get spending start to slow, come off, and then that's the end of spending. But by then you could have something orchestrated by that point. So we'll see. Overall market probably sideways. We're in seasonality also. So for stocks, much different than the economy. Yeah, the drop in 2024. Yeah, be looking for that unemployment rate to start spiking. We talked about that. Stance on Bud. What Palantir? Is that what you said? Planter? I don't know what Planter is. Bud? I always wonder why people are in these. Bud, I mean, this is a consumer stock. Will people keep buying beer? Probably. I would short this. I would short Anheuser-Busch. I mean, I wouldn't even mess with it because it probably has a nasty options chain unless you're going to short shares on it. But yeah, this thing is breaking down. I mean, 55, next support, 53. Look, here's the positive if you're short. If the dollar keeps breaking out here and yields keep climbing, a lot of sensitive stocks are going to get ripped. The big index will keep falling, but not that fast. But the small stocks are going to get ripped. They're going to be absolutely ripped. I wouldn't mess with Bud. They have a social stigma that is affecting their bottom line. Yep, short Bud, short Bud. You could short under 55. I'd say 55 is that where you want to stop out if it holds above. But 55, you could short Bud, and probably goes down to 53. If the market rolls over, it probably rolls over to like 50, maybe lower. So Bud looks like trash. Oh, you know what? Disney. That's was the other one. What's Disney? Ooh, I know a lot of people are in Disney. I'm not a fan, but maybe has long term. Look, in this market, you need a lot of cash. You need a secular catalyst. You need margin. You need pricing power, so you can push that cash into the money market funds. But you need a secular catalyst. You really need fiscal policy. I think that's the only stocks that are going to benefit here are going to be the industrials, energy, right? Which I don't care about energy, whatever. I hate energy. No, I'm just kidding. Industrials, because of the infrastructure bill, okay? anything that has to do with CHIPS Act and Inflation Reduction Act. Other than that, a lot of these are going to get weak. Nobody's going to Disney. If there was a Taylor Swift stock, maybe. Who knows? You need that Taylor Swift stock, huh? What's the name of reverse repo indicator that you use that I can find it in TradingView? I'll throw it up here. So it's going to be, and this is all recorded, so you should be able to find it. RRPONTSYD. You type that in, and it's going to look, what you do is once you type that in, let me move this out the way. You're going to get this. Let me see, which chart is it? It's going to look like this initially. Okay, because this is it. This is the reverse repo liquidity, shadow QE draining into the market, supporting the market, short-term treasuries for the most part. And then if you want to match it, because it doesn't matter how you look at it. I like to turn it the other way just so I know, like, oh, it's coming into the market, right? Whoever it's supporting. You can go down here, click on the Y. Oh, wait, you guys can't see it, huh? My bad. Here, let me remove myself so you can see it. So you'll go down here, you'll click on the letter, whatever letter it is that shows up on your chart, and then go to the inverted scale. That's how I look at it, because it tells me the bottom, right? The bottom of the reverse repo going back up. So it doesn't matter how you look at it, but that's how you get that on there. Global liquidity, you got Fed net liquidity is a little different. But global liquidity should be turning up, especially with Evergrande still collapsing in China. China, look, I know a lot of people are bearish here, but I don't think this is like, I think capital markets appreciate much faster than the economy because the Fed will save the banks first. And if they save the banks, then that means capital comes into the banking sector first. That money is going to go into assets that banks will speculate on that have long-term prospects. It's probably going to be the Magnificent Seven again, right? And I still think fund managers are underweight and they'll be buying. They're probably dumping all this stuff like Disney and Bud Light. Yeah, you're welcome, Tigger. Tigger Media. Tigger Media. Oh, that's pretty close to all right, so and then who else did we have up here? Let's see. We also have yeah, I want to look at some things that might get smashed for you traders, or let's see who can get smashed. Let's take a look at. So here, I'll show you how I do this tool if you're on the screen. I use this FinViz tool. Okay, this is called FinViz. This is the home screen. Now, I already have Screener set up, but you go to Screener, go to All, and then you can customize your screen. This is recorded, so it'll be on here already. This is how I do mine. RVol, relative volume. And so these will be saved so you can see how I do them. I don't want to look at penny stocks here. And then what you do is you go to the charts, right? And then you can see today the stocks that moved the most. And all I'm identifying is the downtrend. Now this is a little more advanced here, because what I'll do is probably look at the 1 month. Should I look at the 1 month? No, I don't want to look at the 1 month. Let's do the let's do the 15-minute. Actually, no, we'll look at the 1 day. I'll just look at the 1 day charts. So this, I'll scroll through DKNG, probably selling off. So I'll flip to my chart. What does DKNG look like? Looks like it's still wedging. I saw some people on CNBC talking about this, but DKNG could be setting up actually to go higher. Very strong wedge there. So I don't know if I'd short that, but you got DKNG, XBI. That's industrials, I believe. See, anything that I'm familiar with. I don't want to just look at anything. Ooh, what is this? Footwear accessories. You know that's going lower from Switzerland. ONO. ONON. But oh, that's gross. Yeah, check this out. ONON. Here you go. And if you don't do this, then it doesn't matter, right? But this is a accessory I mean, consumer spending is going lower. Here you go. Big. Now that's a perfect head and shoulders because the shoulder is shorter than the other side, right? Here's your break. The break is below 25. Not my type of product, but this thing will probably definitely get smashed. And it looks like it's a new company. So they probably have no cash flows. They have a lot of debt. Who knows? So yeah, ON Holdings. That probably goes lower. Dow, VIX, dollar. I mean, some people just short the S&P, huh? It's probably the simplest thing to do if you because a lot of people trade options nowadays. So, uh, S&P, is this Planet Fitness? Oh man, Planet Fitness is getting beat pretty bad. Let's take this off. Whoa, Planet Fitness. What happened to Planet Fitness? You guys stopped going to Planet Fitness or what? You guys canceled your memberships? Damn. They stopped giving out pizza? Enphase. Yeah, Planet Fitness is getting wrecked. Whew. It's a trash gym anyway. Not if you're a starter, it's cool, but usually the staff are lazy. ENPH. Uh, uh ENPH is really volatile. Very Enphase is very volatile stock, but it does have fiscal policy support. Um, and it is showing some bullish divergence here. It's starting to lift on the RSI, and price is falling still or flat. So that's pretty bullish. But I am not sure about Enphase. I know a lot of people like Enphase. I'm not comfortable trading it, but I would say if it can hold 117.50, right? 117.50 probably goes higher. Probably goes a lot higher. Probably has a nice run to 144. Um, but I am not big on Enphase. I'm not that big on Enphase. Let's see. Yeah, so Enphase needs to hold 117.50, but I have been thinking about this as an options play. I probably won't trade it. But there's a lot of shorts in this play. Let me see how bad it's shorted. Meaning it could short squeeze pretty nasty. ENPH. Short flow. I guess it's not that big. 8%. It's not too bad. What about Nvidia? Let's see what else. Nvidia will be great. It'll be fine. I saw some pretty big inflows today. Watch, check this out. I know fund managers are buying it because here's the thing: a lot of fund managers are in cash. They're not going to buy Enphase. They're gonna buy Tesla, Apple, Amazon, Google, Facebook, Meta, Microsoft, and then some other names on the side, maybe. But yeah, Nvidia. Look at these buy. You can see these push higher. Let me see if I could go to a. Let's do this maybe. You can see that Nvidia is not making new lows while the overall market is, and you see these big pushes higher. Comes back down, they buy it again. Comes back down, they buy it again. So Nvidia is making higher lows right now. Now, if it gets violated, you still got support. So I think Nvidia is stronger than the overall market. It's like Nvidia, Tesla. See Nvidia. Let's see Tesla. Tesla, you see the same thing. See that sharp capitulation? They're coming here. They're buying it up. We'll see tomorrow. Obviously, this could change, but compared to the overall market, I think those are getting bought up pretty clearly. Meta, same thing with Meta. Meta, Nvidia, Microsoft. I guess not Microsoft. Microsoft's weaker. Netflix weaker. You don't see it in that. You don't see it in this price. Oh, the price action doesn't show up there. AMD. Man, AMD. That thing could keep slipping. Google. Nope. Google's falling apart. I'm betting up Amazon's falling apart. Apple falling. So it's pretty clear that Nvidia, Tesla, and Meta are the part of the Mag 7 that buyers are stepping in. Yeah, a lot of these are getting beat pretty bad. Palantir. It looks like there could be some buying in Palantir. I guess that was kind of a short chart, but I'm just looking versus the overall market. Qs. Yeah, we looked at Qs. Why Berkshire Hathaway is always so strong? They have a lot of cash flows. Berkshire Hathaway has a lot of cash flows. I mean, oh, this ain't Berkshire Hathaway. BRK hedge. What? I think this is it. Here we go. Yeah, Berkshire is, I mean, it's probably one of the best managed stocks financially. It's not going to be a big mover, but it's going to be in a very strong bull market with low rates. It's not going to outperform, but in a weak environment, it's going to outperform everything else. So Warren Buffett's done his work, him and the team for Berkshire. Still making new highs. Yep. Looks like it just goes straight up. I mean, that is the long-term chart, but yeah, Berkshire is pretty solid. So if you want to be safe, just wait for a big pullback in Berkshire, you know. But it's pretty much weathered the storm for versus everything else. You said the Qs. Okay, let's see. Q. All right, so here we go. Qs, you're in this wedge. Okay. All right. Well, you're in a flag pattern. You're looking at a flag pattern here start to develop. And if we go through the moving averages, okay, let's start with the weekly. Okay, start with the weekly moving averages. You're at the 100 weekly moving average. Okay, so you have that support there, which is also the flag pattern support. So if that breaks, right, if we break, like that's why I said this is day to day. If we get under 353, you're probably going to 348, 349. That's not going to look good for the Qs. The Qs need a bounce at some point. They need to have a bounce. I mean, everything will bounce, but it needs to have a bounce and a higher low. Okay, it needs to have a bounce and a higher low. Now, if we throw on the quarterly moving averages, which are the last couple, let me see, inputs. Oh, these are the quarterly moving averages. My bad. I guess I left them on here. Yeah, 12, 26. So this is the last 2 quarters of earnings. Dang, I've been looking at these wrong. No wonder. Let me see. Let's go back to this. So the quarterly moving at the last 2 quarter of earnings is still holding on. No wonder I was so mixed up. Okay, that did not make sense. All right, now let's go to the look how clear this is. This looks even more bullish. If we look at the moving averages for the weekly, we're still that 50-day moving average is still lifting. So that's a lot more bullish. I was gonna say something didn't look right the other day. I messed up my technicals. I got it mixed up. So we're slipping the 100. We slipped the 50, but the weekly is pretty good. You got the 200 moving average. Some people are looking for that 200 moving average. So then what is the S&P looking like? How did I mess that up? S&P's at VWAP from the banking crisis. Still has some room to come. We could come back down to 4,200 or 420 if things really get bad. Let's go to that weekly. Weekly. See, the weekly is a lot more bullish. If you take a step back, right? If you take a step back, this is pretty bullish here because if you take a step back, you have S&P on the weekly time frame pulling into it's kind of falling below that support, the bottom edge of that support. But you have the 50-day weekly moving average very steep. The angle is important. The angle shows a lot of momentum. This may be what fund managers are waiting for, is to buy at these averages They want to see a bounce. So we're looking at 420, which makes sense, right? That was kind of the level that we broke out of. So we retraced all the way back down. I didn't think we were going to do it. Um, but we retraced almost all the way back down. This suggests that we're still in a bull trend. Okay, we are still in a bull trend there. Tesla is still holding that trend too at 241. For Tesla, it's 241 is like the last resistance. Support, my bad. 241, in my view. If that drops, it's gonna be gross. It's gonna be nasty because then you have this big upside trend that started way back here, starting to roll over. Keep this on the log. Yep. Tesla really needs to hold that. What is this? Double top on weekly though. Are you talking about Stenotrophomonas? Why do you guys have such difficult names? Stenopatropodolis. You guys are gonna be having these crazy names. Can't even pronounce them. Why can't you just have a name like Bob or Troy? All right, so are you talking about the Q's double top? SPY. Yeah, 50-day moving average. Wow, I can't believe I was looking at the quarterlies. Well, we got the last 2 quarter of earnings turning up, and we're above the 50 on S&P. Jumping to the daily. Okay, the daily's bullish because you're oversold. So this is a good setup. I think the fund managers will step in by the end of the week unless we get some really bad news from the Fed. But we're testing VWAP. We're testing anchored VWAP from the banking crisis. We're at the big level. We're at a very important level. We're kind of bearish on it. We're still above the 200 daily moving average, and we're oversold. So still a lot of support here. I think we just pull up. And the real question is, can we hold above 431 again? And can we get past 444? Maybe we don't. Maybe we just keep downtrending, but you're going to have some upside on the downtrend, right? You still have some upside on the downtrend. All right. Start throwing your questions in. I'm gonna turn it off from here unless you guys have questions or anything else. I think we went over everything. Let's see. Let me double check. Real rates coming down. Real rates remain restrictive for some time. Tom Lee did have some bullish stuff. I don't know if I really believed it though. It was about the cost of capital being so high. Here it is. EPS higher equals higher. So what he says is 3.5 to 5.5% is the sweet spot for stocks, which is higher nominal GDP growth. So the reason why rates are up is because GDP growth is up. So that's going to be better for stocks. Higher GDP. Are you ready to short orange juice? Bro, what is orange juice, man? Is that literally a commodity, orange juice? About to short orange juice? Margin higher. Oh, you know what? There's some other people, what was it? Debt margins are going up. People are starting to leverage into the market. So we're getting margin going up. I remember seeing that chart. I think it was Bank of America. I thought I reposted it. Maybe I missed it. But debt margin going up. So people are starting to unleash debt margin into the market. Well, what's the ticker for orange? I mean, I guess it's not a ticker with orange juice. Orange juice, bro. What? No way. Oh, orange juice is exploding. Psh. What's up with all this? Why is orange juice up so much? That it doesn't look like it's going to slow down either. Looks like it's just going to slowly trend up. Well, I guess you should start selling orange juice. Kids love orange juice. What is this? Government spending on orange juice? Yeah, that's pretty crazy. It looks like Elf Beauty back in the day. Oh, look at Elf with the pullback. This might be an entry. Makeup industry. Come on, you guys know the makeup industry never slows down. It just converts from stock to stock. As long as you got YouTube and social media and Instagram, this thing's going higher. Hey, what up, Yassine? Yeah, go ahead. You have a question? Go ahead. Let me know. Future value, high cost of capital. Um, Cacao is a good short now. Cacao, so chocolate. You guys are in all those commodities, huh? I mean, I guess I don't see it. I don't see the ticker on here. Could you just type in chocolate? No, probably not. Go ahead, Yassine. Throw out your question. Ooh, Alta's getting smashed. Guess nobody's shopping there. 400. Okay, here we go. I see these news messages about the US government shutdown. Could you explain what they mean? Um, I mean, I'm not the best to explain that, but basically the government shutdown is right now the government needs to figure out how they're going to spend all the money that they're collecting from the US treasuries. So they're dumping treasuries on the market. And they have to fund the government somehow. So they just haven't agreed on how they're going to fund it. And all you got to know is basically it's a scare tactic. It's geopolitical. The market doesn't really believe it. It will price it in a little bit, but it's not like a very systemic issue, right? It's not like higher rates for longer. That's systemic. You got to change how you do business. But the government shutdown is just posturing from politics. They just can't agree on how they're going to spend the money. Basically, they're going to do it. They're going to, it's not going to shut down maybe for a day or two. And maybe the market like sells off, does nothing, and then gets resolved. We saw this back in April. Saw this back in April, the debt ceiling, right? It's just how the politics are going to spend the money. It's not really, I would just shrug it off. Now, can it affect your trade? Sure. But again, it's nothing systemic. It's more of political posturing. They're going to end up spending the money. It's more so for the Republican slash Democratic, uh, political media, right? Stock finance knows they're gonna be fine. It's just causes havoc in the short run. Now, could something slip? Could something go wrong? Sure, but nah, it's not gonna happen. Their job is at risk there. Yeah, this is in the news. In 4 days, if they do not approve the budget, this closure will be the 14th in the American government. Um, yeah, probably. I mean, I remember when they shut the government before, but again, they have so many backup plans. They can just trust me, there's so many, I don't even know how to talk. Like, I'm not privy to this. This is not my specialty. But there's so many backup plans. Oh, well, if we shut down, we're going to do this, then we're going to do the market just wants certainty for stocks anyway. So as soon as they get certainty, they'll come out and give some certainty. They're just basically trying to negotiate where the money goes for the spending, where not to spend it, where to spend it. They can't agree on it, but they'll pass it. They'll be up all night. You'll see it on the news. Literally, you're going to see it on the news. It's past midnight and now they are working on an agreement, blah blah blah. You guys know the picture. You know the deal. It's past midnight and Republicans have now blah 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 and Democrat blah, blah. It's just a bunch of bull crap. Yeah, it's a bunch of bull crap. I don't think that it's materially going to change anything, so I wouldn't be too worried about that. Is that all the questions we got for today? There's always a bull market somewhere. There's also a bear market somewhere. So, um, I'd say that you guys got to definitely watch for the dollar. I'm gonna leave it at this. The UAW strikes are a bigger deal than the government shutdown, not student loan repayment. That's not going to be a big deal. The UAW strikes could really mess up the supply chain and spike the unemployment rate at the same time, which is stagflationary because now people don't have money, growth slows, vehicle prices go up, that factors into core CPI, CPI. That would be bad. So the UAW strikes are probably the worst of all these things. Could you explain this effect on central bank balance sheets in the U.S.? State decreased to blah, 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 USD million in September 20th in the previous week. Oh, central bank balance sheet? You talking about the U.S.? Yeah. So if you are on a trading view, sorry, my brain is slowing down. Just type in wall clave. No, I'm just kidding. Just type in wall CL. Okay, this is the US central bank balance sheet right here. Wall CL. And oh, did I put that on wrong? Sorry, I probably put that on wrong. Let's jump over here to, actually, no, I'll just type it in here. Okay, wall CL. This is a government, this is a central bank balance sheet. And take off the moving averages, that doesn't matter. So I think what you're pointing out here is, and then I'll change this to columns. See, this is the central bank balance sheet. And it's just, it's basically the Fed. I talked about this earlier in the stream. The Fed is dumping assets onto the market. And this is basically the assets they're dumping, right? They started back in March of 2022. They've been draining it. This is the banking crisis that had to increase assets purchased, and then they're shaving them off. So it's the Fed's balance sheet selling U.S. Treasuries, mostly on the short end, and mortgage-backed securities every single month. So it goes lower and lower. And what that does is they're forcing banks or money markets to buy these treasuries, these assets, which, how do you buy them? With cash. So they're sucking cash out of the capital market system by forcing banks to purchase these assets. So that's the balance sheet going lower. Does that make sense? Is this good or bad for the dollar? It's good for the dollar. The more that they pull, because what it does is it pulls dollars out of the system. The more scarcity of dollars, the higher the dollar goes, right? The more they tighten. So what you could do here also, just so you could see this visually a little better, Yassine, is here's the central bank balance sheet, right? There you go. You have the ticker up there. Type in DXY. Oh, wait, no, don't type it in. Plug in DXY. New price scale. And you can see, turn this into, I don't want the dollar to look like that. I want to turn the dollar into a candlestick. There you go. So you can see that now the dollar did go up before that, but you can clearly see that the dollar, trying to get this where you can see it a little more visually. Okay. So right here, the central bank started shaving. First of all, they announced this. They announced it back in November of 2021. So as soon as they announced it, okay, as soon as they announced we're gonna start taking off, we're gonna pull the balance sheet. We're basically gonna drain liquidity or drain cash from the system. You can see they started that here. The dollar went up the whole time, even though they were still pushing cash into the system. The dollar went up because they announced it. That was a risk off signal. When they actually started doing it, the dollar kind of consolidated and they started actually shaving it off. Boom, dollar went up. But inflation peaked, right? I'm sorry, inflation bottomed, the market bottomed, and the dollar rolled over. You see the dollar also sold off. So the dollar did come down with the balance sheet, but that's because it was just up too much. And there was a belief that the bear market was over, right? The global markets actually peaked here. So the dollar kind of came off. But, and also people were pricing in the Fed pivoting, cutting rates, or no longer taking this balance sheet lower. And when they actually did bring it up, the dollar sold off, right? The balance sheet goes up. They actually print more dollars, or they push dollars back into the system. You're reducing the scarcity of the dollar, more abundance, lower prices, right? And then they kept shaving it off. So the dollar kind of consolidated, but rates are going up this whole time also. I know this is a lot of information, but net, the lower the balance sheet, the higher the US dollar, because this is basically the balance sheet is basically reflecting um, the reduction of cash in the system. You reduce cash in the system, you make cash more valuable in the system because there's less of it. So that's what that means there. Credit is going to play a big role. Yeah, credit will. Right now, credit is okay though, which is interesting. Credit hasn't really moved. Equity credit hasn't moved yet. Yeah, so the dollar, we're still looking at the dollar breakout here. You know, the other part too is that the reverse repo started going up. Man, there's a lot of things to look at, but that's all you got to know, Yasin. All right, if that's it, I'm out of here. Appreciate you guys. Make sure you guys, we'll stay tuned. We'll see. This is gonna be a crazy week, right? A lot of volatility happening, makes for an interesting market. We'll see the new news that comes out. More than anything, watch the U.S. dollar hold above 106. That is the risk-off signal, along with rates rising and oil. Those three things are probably the most important macro forces. You see all the news, but the news, you can't. It's all sentiment. Those are real indicators of what you're gonna see next. So if they ease, markets are gonna ease a little bit. We'll see what happens. You guys stay blessed. I'll catch you tomorrow again. Have a good day. Yeah, no problem. As always, stay blessed.